Hey everyone, it's Aaron. Janet Yellen, the Treasury Secretary, has just announced and warned that the U.S. is imminent in defaulting on all of our debt. Sometime in October. This is going to be a crazy catastrophic event if this actually were to happen. And it would be the first time in U.S. history if the U.S. were to default on debt payments. So the key thing here to understand is we've kind of been in this situation before with having to deal with debt ceiling being approved for an increase by Congress. But this one's particularly troubling because it's already to the point where we've spent too much. We don't know that we can forecast enough revenue coming in, according to a letter that Janet Yellen wrote to Congress. And so these things, the way Janet Yellen is seeing it, are not going to be able to support us. The money that we have coming in and the rate of spending that we currently have for the U.S. government, it's just not enough. And something has to give, which typically means either spending, which probably isn't going to happen, increasing taxes, probably will, but not quick enough, and so then therefore raising the debt ceiling, where we say the line in the sand with where we are accepting the amount of debt that the U.S. government has at one time, we're just going to increase it. And we are already at historic highs. I mean, even several years ago, the debt ceiling hit historic highs. And we just keep seeming to be pushing further down the road, just kicking this can. And, think about it for yourself in your own world of taking out a mortgage or, credit cards, personal loans. At some point, if you were maxed out, the banks wouldn't give you any more money. And that's a big concern because private investors, other governments, they're the ones who buy U.S. debt. They're the ones that we borrow from. You know what I mean? So in this video, I'm going over the specific issues that Janet Yellen called out, but also talk about some of the implications of if the U.S. were to default, but even if we don't default, which I doubt we will because, oh my God, we can't. But really it's about how we keep kicking the can down the road and it erodes the trust in the U.S. economy, the U.S. dollar, and the U.S. government. And that erosion of trust with the U.S. dollar could threaten our reserve currency status. So go ahead and smash that like button. This allows YouTube to show this video to people who are interested in not just the economy, but specifically how the U.S. government is dictating their financial future by playing with the money that we take in, the money that we accept for borrowing, and a lot of different factors that are going to impact your wealth, your family, your business, your income, and your savings. So go ahead, smash that like button, and let's get started. All right, let's take a look at Janet Yellen's letter to Congress. I'm writing to follow up on my previous letters regarding the debt limit. So already she's like, yo, I've been trying to get a hold of you guys and haven't heard anything. Kind of important, we need to talk about this soon. And to provide additional information regarding the Treasury Department's ability to continue financing the government in absence of congressional action to address the debt limit. After the debt limit was reinstated on August 1st, it was reinstated August 1st after a 2-year temporary suspension where we pretend we don't have a debt limit and so that we could just spend more. But now the debt limit automatically reverted to being in effect, and suddenly we realized we had already spent basically that much money. We'll go into some numbers later. After the debt limit was reinstated on August 1st, Treasury began employing certain extraordinary measures to continue to finance the government on a temporary basis. These measures, which are authorized by law and have been used in previous debt limit impasses, include a suspension of certain investments in Civil Service Retirement and Disability Fund, the Postal Service Retiree Health Benefits Fund, and the Government Securities Investment Fund of the Federal Employees Retirement System Thrift Savings Plan. Basically what she's saying here is the Treasury has stopped paying into the benefits fund for postal workers and the retirement fund for government workers. Basically the equivalent of a government worker's 401k. Imagine your employer suddenly being like, yeah, just kidding, we actually can't match your contributions anymore, so we'll try and make that up later. So that's basically what they're saying, and we'll get more into why these are being used to fund the current expenditures of the government, but it's very troubling. Let's continue. Once all available measures and cash on hand are fully exhausted, the U.S. would be unable to meet its obligations for the first time in our history. Wow, very disturbing. Our estimates of the period of time the extraordinary measures will last have been refined in recent weeks, although they continue to be subject to considerable uncertainty due to the normal challenges of forecasting the payments and receipts of the U.S. governments, including when taxes will be paid on the 15th. I'm going to skip ahead a little bit. Obviously, things are heightened by what's been going on the last 18 months. Given this uncertainty, the Treasury Department is not able to provide a specific estimate of how long the extraordinary measures will last. However, based on best and most recent information, the likely outcome is that cash and extraordinary measures will be exhausted during the month of October. So that means the U.S. has basically been running on fumes since August 1st from a financial perspective. On fumes because we were already right up there close to the debt limit. But the ways that Janet Yellen was trying to pay for it and kind of keep everything together was by robbing ourselves, robbing government workers. And I don't mean robbing as in stealing, but I think the intention is if the debt ceiling gets raised, then they'll make up the payments that they didn't give. But they're deciding to not pay certain things because they have to service the debt. The number one priority of any government that is interested in keeping its credibility from a financial perspective of its debt that it loans out in order to raise money is to make those debt payments. You cannot default. The first rule of Federal Club, you cannot default. So this is troubling because now we're coming down to a last-minute decision. And partisan politics may take a center stage here yet again, where we're going to hold off on the actual legislation required to increase the debt limit and kind of save the day so that deals can be done, points can be made, political opponents can be eviscerated, whatever happens in Congress around these topics when it comes to debt ceiling impasses is going to be, unfortunately, subject to personal desires, or party lines, rather than for the good of America and good for the economy. We have learned from past debt limit impasses that waiting until the last minute to suspend or increase the debt limit can cause serious harm to business and consumer confidence, raise short-term borrowing costs for taxpayers, and negatively impact the credit rating of the United States. So I was saying a moment ago that the credit rating of the United States or of any country is something that communicates to investors how risky is it to loan money to this government. And for the U.S. to default for the first time in history, treasuries, the treasury bonds, treasury notes, treasury bills, but in the markets, we always describe it as the risk-free rate of return because, of course, the U.S. government isn't going to default. Therefore, there's no risk. And so anything above that, like if you invest in certain types of bonds and corporations or stocks or crypto, all that has a higher return than the risk-free rate of return because it's more risky. But now if we call into question the sovereignty or the stability of the U.S. government's ability to pay back its debt, cataclysmic and catastrophic ripples will come out from this. She details a bit more in her letter why. A delay that calls into question the federal government's ability to meet all of its obligations would likely cause irreparable damage to the U.S. economy and global financial markets. At a time when American families, communities, and businesses are still suffering from the effects of the ongoing issues of the last 18 months, it would be particularly irresponsible to put the full faith and credit of the United States at risk. So then she urges Congress to take action. So this is troubling because three things happen. So we see here this article by The Balance concisely details the three issues that would happen should the Treasury default on its debt. So if the Treasury did default on its interest payments, three things would happen. First, the federal government would no longer make its monthly payments on the debt, of course. Employees would be furloughed and pension payments wouldn't go out. Remember, the U.S. government has hundreds of thousands of employees, just like a company in a sense, and they have to be paid. So if there isn't money to pay them, then they have to furlough those employees, meaning we're not going to pay you for X number of weeks. You still have your job, hopefully, but during this time you will not be paid, so don't come to work. And then next, pension payments wouldn't go out. So any retirees from the government that have a government pension, they would not get their payments. So that's really troubling. And then, of course, all those receiving Social Security, Medicare, and Medicaid payments might not receive their funds. And federal buildings and services would close. So that's just one issue that would happen. Second, the yields of Treasury notes sold on the secondary market would rise. That would create higher interest rates. This would increase the cost of doing business and buying a home and would slow economic growth. So when a bond's yield, or the interest rate that it pays you, the lender, when that goes up, that communicates more risk. Number one, for you, the lender, but number two, it increases the cost to borrow. And if the Treasury and the U.S. government is kind of the cheapest borrower on the face of the planet, the interest rates that they're able to get because of the understood stability that they have, it's low single digits percentage points. But on trillions of dollars, even if it ticks up a little bit, it's a meaningful dollar amount because it cascades downstream, because banks get money from the federal government, from the Federal Reserve, or at least use it as a benchmark for what they should be lending, and then they lend above that for mortgages, personal loans, credit cards, things like that. So it's going to drive the cost of borrowing up, and that makes it more difficult for businesses to be able to access capital to operate, because maybe they can't afford higher interest payments on that type of debt. Or maybe if you go to buy a home, the cost of the mortgage is higher, and therefore it hurts your ability to afford the home that you're looking at. And we know home prices are through the roof anyway right now. So it's just kind of this double whammy effect that makes the cost of money too much for the economy. And then consumption slows, less homes being bought, less businesses being formed or expanded. And businesses sometimes are using debt right now after the last 18 months has been really crazy. You may be using debt to kind of float the business. And if they can't, they're going to have to shut their doors. And then third, and probably one of the most catastrophic effects that would happen if the U.S. were to default on a payment, owners of U.S. Treasuries would dump their holdings. That would cause the dollar to plummet. The dollar's drastic decline could eliminate its status as the world's reserve currency. Over time, the standard of living in America would decline. In this situation, the U.S. would find itself unable to repay its debt. And they say, for all these reasons, Congress shouldn't monkey around with raising the debt ceiling. If members are concerned about government spending, they should get serious about adopting a more conservative fiscal policy long before the debt ceiling even needs to be raised. Sage advice makes sense. The debt ceiling is more of a symptom. It's not something that I think you should toy with, and it's something that unfortunately you just get painted into a corner after the U.S. has decades of just spending and spending, doing tax cuts or spending in other ways without an actual way to pay for those programs or offset where that revenue has come from. This is why we're in this situation now. So the important thing for you guys to understand is the U.S. is basically the biggest credit card in the world, and we are once again on the precipice of defaulting, which could truly change the way our lives are lived and our economy functions if it actually happens. So it's a little scary, but I want us to have this knowledge and be prepared. If the default does happen, that means the value of the dollar is going to plummet, right? And so having assets that are, hard assets, things like real estate, gold, is going to be probably a better move, a better choice in that world. I mean, yes, everything will take a hit most likely in the initial event, but after that, having something that you can rely on that does have value independent of the US dollar is going to be much better. Now, in that last comment about if this does happen, Treasury holders would sell all their holdings, causing the dollar to plummet. Well, who even holds US debt? You may be surprised by some of the biggest holders. Let's take a look. So it says here that the two largest holders of our debt that are foreign are Japan and mainland China. This is crazy. So Japan has almost 1.3 trillion and China has just over $1 trillion of US debt. So this is a massive economic interest in the future of the U.S. economy, the U.S. dollar, and the default of that debt would cause the value of it the dollar to fall, and that would make their debt load of $1 trillion become a lot more of a risk to them and become less valuable. And next, how much debt are we even talking about here? Well, if we go on the Treasury Department's website, it easily tells us. So we go ahead and we select 10 years for the date range of how much the U.S. debt holdings have been. And we see most recently, it's on the 15th of September, the total debt is $28.4 trillion. That is crazy. I mean, wow. Now I want to show you something interesting. If we remember, we selected a 10-year time frame. If we go to the last record 10 years ago, what was the debt? It was basically almost half, $14.7 trillion on this day in 2011. So what we have here is a dramatic increase in debt spending. You think about what happened over the last 10 years. Yeah, there were tax cuts. You know, we were still funding the war in Afghanistan and Iraq. And it's just like, where are the heads of our politicians at? You know, we are completely out of control. This is unsustainable. If this were a person, if this were a corporation, somebody has to tell them to stop. You know, investors would stop giving them money. Parents would stop giving the kid, you know, the credit card access for spending like this. So what are your thoughts? Do you think that we should increase the debt ceiling and kind of kick the can further down the road so that then we have more time to enact a more conservative fiscal policy? Or do you think that we should pay the piper now and cut out certain programs so that we can stay under the debt ceiling without raising it further? This is a very interesting topic, and I'd love to see your comments below. And keep following this channel for more information like this. Go ahead and smash that like button and get this video out to more people, and consider subscribing. I'll see you next time.